Oh, hello everyone. My name is Simon Misiewicz from Optimise Accountants, and I'm going to be doing my first ever live webinar where I'm going to be doing three sections. Oh, I'm hearing an echo, so just bear with me a second. And I'm going to be doing my first. You shouldn't have heard that, so apologies for that. Technical glitch on my first time of asking. Isn't that just great? So what I'm going to be doing with you guys tonight is covering off three sections. First of all, I'm going to be talking about what's in the news. What are the papers saying about the world of property investing and the world of property tax? And at the same time, I'm going to cover off the frequently asked questions by our clients of Optimise Accountants. And it really will help shape what the papers are saying in stark contrast to what I would call the property investors who are professionals in this. And lastly, I'm going to be picking up on the FAQ, so looking at your questions as well. So if you are on YouTube, then please feel free to type in your questions in the comments box. I'm going to find out how I get onto that page without looking too conspicuously as I look away from the camera. But if you are on the webinar, because you've registered via other means, then feel free to type in your questions as well into that section. You will see me peering down as I look at questions. That's only because I want to make sure I get all the questions that you've asked. I'll just make sure that my table isn't too wonky as well. That would be a disaster. So I'm live on YouTube. Yes, I'm indeed live. I've not seen any comments yet, so I'm hoping that I can go on to that later on. But I'm going to go on to the chat box. Already, I can see that someone's asked a question. I own 2 buy-to-lets. How do I best plan to avoid CGT? I'm going to cover those questions, so keep them going through. What I'm going to do is do the first section, which is in the news. But if you do have questions, feel free to ask those questions, and I will do my level best in terms of answering those this evening for you. But it's interesting reading the press, and I've got my documents open for the things I've been reading. And funny enough, one person's on the live chat has already asked about capital gains tax. Look, guys, in the news, it's a very depressing subject right now around the world of property investing. Most of the articles I've read and the blog posts from the major tabloids have all pretty much said buy-to-let is dead and you should not be investing in that anymore. I'm not sure I agree, but there is one thing that I would resign in the fact that Warren Buffett once said that when people grow fearful, you need to grow greedy. And when people grow greedy, you grow fearful. Well, if you read the press, if that is what I would call the general consensus of the UK, that people certainly are feeling relatively fearful about investing in property. And my view, when I look at the alternatives, which is you've got your gilts, your bonds, your high interest accounts, your shares, which, you know, the FTSE 100 is really on a all-time high from my perspective. You know, there is always issues around those kind of investments. Bank interests aren't doing so great as well. So my money is going straight into property or indeed into my pension, which I'm trying to get into property through that as well. But capital gains tax did come up as a question. And one of the things that people talk about is the amounts of capital gains tax rates have stayed the same. So albeit for different types of investment assets, those assets have gone down in terms of rates. If you're a basic rate taxpayer, the CGT rate dropped from 18% to 10%. And if you're a high rate taxpayer, that moved from 28% down to 20%. But with all the changes attacking landlords, they did not change the rates of tax for the residential property investments. Furthermore, we have got something I was going to come on to later on, but since it's a question here, there is also another attack on landlords next year, April 2020, with the reduction of private residence relief. So before, if you purchased a property and you moved out of it and you let it, you could get private residence relief for an element of time of when the tenant was in the property. That's going to be removed, and therefore you won't get so much of the private residency relief. You won't get the lettings relief as much as you did before. So the amount of CGT that you'll pay will increase from April 2020 because of that change. So that's another stealth attack. But one of the questions, interesting enough, I'm just going to go into, wow, I can see that someone's already posting on our chat page, which is great. I didn't think this was going to happen, but it's also come through my page here. So I'm going to read it. It says, "Oh, to buy-to-let, how do I best avoid CGT? How might I protect myself from the impact of Section 24? And I'm going to go just onto the first bit, and I will talk about Section 24. The capital gains tax, there's a couple of things that you need to bear in mind is when you're selling a property, you do have something called a capital gains tax annual allowance. And right now, I think in the next tax year, which is when people probably sell their properties, the allowance will be £12,000. If you are selling a property just yourself, you will get £12,000 of gain that won't be taxed. And then you'll be taxed at, like I said before, 18% if you're a basic rate taxpayer, or 28%. Now, I've spoken a lot about this in my articles, so you do go to optimiseaccountants.co.uk. Never forget about the website, mainly because I'm kind of really gearing for this tonight's session, and I'm trying to not fluff my lines. So ultimately, you can get the tax, as I mentioned. But if you're a single person and you're married, then why not do a deed of trust, which allows you to share assets between one another, and it'll be free from tax, especially when you think about selling it. The reason for that is because one person gets the CGT annual allowance rate of £12,000, and so does the other one. So you've got £24,000 now combined, whereby you've got your two lots of CGT annual allowances in effect. And you can do that via deed of trust. Deed of trust will cost you about £300. Optimise Accountants will do that as well for you. So just send an email to info@optimiseaccountants.co.uk, and we'll do a deed of trust, which is a legal document, and a Form 17, which tells HMRC that you're resplitting the asset. And you might not want to do it just 50-50. You might not want to do it 99% at 1%. We will try and work out as well the most optimum amount of tax that you'll pay by looking at your circumstances in terms of how much money you're earning, as well as your spouse. And by the way, this only works for spouses, so you need to be married or in civil partnerships. So married, civil partnerships, you can use these deed of trust to manipulate how much percentage that you earn, so that you pay the minimum amount of capital gains tax. So someone talks about that. The other things that you can do, CGT is one of those taxes for my money that is totally optional, by the way. So you don't have to pay CGT, it is optional. And the reason for that is because you can invest into EIS, VCTs, or EIS stands for Enterprise Investment Schemes, which basically is another form of investment. So as long as you take your gain, your net gain, this is after your CGT and your allowances, you can invest that. So that's one way of mitigating that CGT. And if you do it properly over a period of time, you do not need to pay CGT at all. The other side to it is VCTs, so venture capitalist trusts, whereby you're investing into small cap organizations. You need to go through an IFA or a wealth manager to do all of these things. It's a regulated activity, so don't please ask me to do this because I'm not regulated and I won't be able to do it. But CGT is, like IHT, very much an optional tax. You don't need to pay it. So hopefully that's answered that question. And I can see lots of questions coming in, so which is great. So I'm going to try and cover as many questions as I can possible, but equally I'm just consciously aware that I'm only here for an hour or two, so forgive me when I do this. So the next bit I want to cover off in the news, and apologies for my camera angle, but I'm trying to do this. I might move my laptop so you can see me here. The second one is selling properties because of tax and CGT. So in the news, people talk about selling properties because of Section 24, the increase of 3% SDLT. And interesting enough, if you're on YouTube on Thursday night, that's this Thursday at 7 p.m, I'm launching a new video talking about the 3% SDLT surcharge and how you can minimize that. So be on the lookout for that video on our YouTube channel so that you can pick up on that. But there is a lot of negativity around every bit of press that's going on, not just because the Section 24 and 3% SDLT surcharge, but they was highlighting as well about legislation changes in terms of letting agents are no longer allowed to charge certain fees to tenants. So that will probably be passed on to the landlord, and guess what? The landlord will pass it through a rental increase. So really, the tenants aren't going to benefit from any of these changes, let's be honest. What was interesting was the debate around the commercial property investing. Lots of people talk about residential property investing, but I've for some time have discussed the option of investing in commercial properties. So that is options such as shops, you've got retail units, you've got warehouses, you've got restaurants, you've got many different types of commercial properties you can invest into. And the reason for that is because Section 24 doesn't apply to those types of properties. And indeed, when you're going to sell those type of assets, then you're not going to be subject to the high rates of CGT as you are residential property investments. We are seeing a number of people, funnily enough, and it was picked up on the press as well, is that people are buying commercial properties to convert them into residential. And again, it's an article that I'm writing, which will be released in the next week or two, where it talks about people buying commercial properties because they do not need to pay the higher rates of SDLT. And conversely, the conversion costs of that refurbishment, the VAT rate is also reduced from 20% to 5%. So there are quite a few angles in terms of opportunities that people can save a lot more tax. And this is now glass half full. And talking about glass half full, I'm going to rehydrate myself to make sure I don't go with a cotton wool mouth. So that was a picture in the press about alternatives to property investment. And I thought that was quite a good insight to a positive angle to the world of property investing, not necessarily positive from the perspective of residential property investing, but certainly still within properties, but flipping it on its head and looking at commercial. So in this section, what I'm going to try and do now, hopefully, there's a few questions that have gone on. So I'm going to just hit onto that now and see what questions we've got. So the first one, wow, there's quite a few questions that have hit out. If you can put it in your chat box, I know there's a Q&A box, but I'm going to try and not go onto too many pages. I do get lost. So Said, I think you've asked a question on the Q&A box, so I'm going to just move away from that. So I'm just going to move that. So Said is asked, if me and my mother get a mortgage as a joint application, then I do a deed of trust where 99% of the ownership is on my mother. Can this be done? Yes, you can do a deed of trust whereby you get a mortgage, and you need to do it at the time when you both are equally responsible for that mortgage, but you can put a deed of trust in place whereby one person gets a certain amount of beneficial interest in that property, even though the legal entitlement could be 50-50. So what you have to remember, there's two ways of owning or getting benefits from a property. And the first one is legal title, so who actually legally owns that property. And the second side, which is all about tax, is the beneficiary interest in that property. So if you did a 99 and 1% split, yes, you can do that. There are no issues with that. Do please consult a very good property solicitor. Sam Hawking is one that we often recommend, so it's worth speaking to him about that. So that's good. Let's go down. When selling, so next question is, when selling a flip property, can you use profits to purchase another property? Okay, so the question is, if I sell a property and I make, let's say, I'm just elaborating on the question now, but if I bought a property, refurbed it, and it cost me in total 200,000, and then I sold it for 300,000, therefore earning £100,000 worth of profit, can I use that to reinvest it in a property and then avoid CGT? And the unfortunate answer, No, the £100,000 would be taxable. So that is a capital gains tax, and then you would use a net after tax to reinvest that into a different type of property. There are certain circumstances whereby you could use what they call asset rollover. If you use the property in your trade, for example, if we sold our accountancy building and then reinvested that money into another building, we could get some relief on that. But in this context, I rather suspect it's about residential property investing or commercial property investing, whereby you're getting a rental income, and therefore you don't get that benefit, unfortunately. So good question. Wow, there's more coming in. Let's have a look. So that's one. So thanks for that, Jack. Mark has asked the question: can I set up a limited company and get the company to bill me fair rate for maintenance management? Can I set up a limited company? I'm not sure if you would want to set up a limited company and then try and get money into your own coffers through maintenance and whatever else. What you could do, which is something that we've explained very thoroughly on one of our website articles, talks about how you extract money out of a limited company, whether that be earnings as an employee, but indeed in terms of how you can get dividends out of your limited company as well. What I do find interesting is that people do set up quite a few limited companies thinking that they're going to save quite a bit of tax, and sometimes that doesn't really happen. But they've gone to the expenditure of setting these companies up and then maintaining these companies all the way through the year as well. So make sure that you do your due diligence with a tax advisor to make sure you are setting the right structure before you do anything, because sometimes it costs you more to unravel the issues that you may face by setting up the wrong structure. But it's an interesting question about the using a limited company. If I do with my spouse, she's currently studying. Once she graduates, she will be expected to have a percentage back. So this is side where he's got his mum and he's taking 99% and she's taking 1%, or vice versa. Will the income from the property be classed as income by which she is required to pay? If you have profits from a property, it is an income and it's taxable income, so the net profit. If you decide to change the beneficiary interest, let's say it's 99% to you, say 1% to your mum as an example, and you wanted to later change that, you could have tax issues. And I'm not just talking about income tax, I'm talking about SDLT, because you're changing the boundaries of the mortgage. So sometimes you have to be a bit careful about how you set these things up. Again, I would get tax advice about this and legal advice as well, just to protect your interests, even from your mother. If you're American, you're probably used to suing each other. But I would honestly get some questions on that. So Rob's asked the question, if I sell my property, my residential flat to a new SPV for 250k, and the SPV only has a cash balance of 200k, can the solicitor actually complete on the sale? Physically, only 200k will go in the hands of into my hands. The remainder 50k will be shown as a direct loan. So yes, in answer to that, even if your limited company does not have all of this money, say if the company wants to buy your property for 300,000 and it's only got 200,000 pounds, you kind of think, well, where do I get this extra 100,000 from? Well, it's in effect, it's going to be treated as a director's loan, so the company will owe you this money, and you can take that back anytime you wish, and it will be tax-free. So hopefully that's giving you a bit of an idea there. So let me just get rid of this Q&A, because this Q&A is now stopped working. So I'm just going to say hello to guys to ask them to ask questions on YouTube, because you're asking lots of YouTube questions here, but not on YouTube, which is interesting. So I might need to let's have a look at that. Okay. So the next question is, if so back to the Rob, who's asking the question, can I sell my property can my limited company, buy my property for 300,000? He's gone on to say, if so, how, e.g. does the solicitor have to draw up a separate loan agreement so that the sale can go through? Yes, Rob, the separate legal agreement would need to be used as a loan. And in the future, if the SPV needs to be taken out mortgage, will the outstanding loan from the SPV cause an issue with getting a mortgage? No, it won't, because the company will still owe you this money. And the fact that it's a direct loan, you could write it off if it does cause you problems. It's unlikely that it will cause you issues, to be fair, because most mortgage companies will look at the property first, and then they will look at the company's finances / your finances. So they'll look at you collectively. So hopefully that won't cause you too much trouble. Jodie's asked a question. I'm trying to set up a correct structure, LTD or personal. Is there anything I could need to be aware of with direct loans? The company owes me because I use my own personal cash or deposit buy to let, thanks. And if I charge my company interest, is there any complications with this? Great question. Someone's just asked the question, if my limited company owes me money, first of all, can I charge it interest? And the answer is yes, you can. In all honesty, I would say don't, because all of a sudden, your limited company has now got to do something called a cited 61, which is the payment of interest to you as an individual. And that's a quarterly return that needs to go in. It's more paperwork. And to be honest, for the amount of benefit you get, it's not worth it, to be honest. A lot of people try and look at the amount of interest. The company says 19% tax because its interest is a cost, but then you're taxed at 20%. So net effect, it probably wasn't worth it from a tax perspective, in all honesty. Or if you're a high rate taxpayer, it'd be even higher, of course, because you'd be paying 40% tax. This is not the most elegant of way to drink a bottle, I appreciate. So next time I shall bring professional glass. So let's have a look at another question. So, oh, crikey. So Said, unfortunately, I'm going to have to skip past your questions because I think we may be going into too much detail and I've got so much to get through. So book a tax call if I was you on that bit, or really go to Google, type in Optimise Accountants, deed of trust, and then that will tell you all the details you need to know. So Said, sorry, but I do need to move on from that kind of question. So Perver has asked a question, if I'm buying 2 commercial properties from the same buyer, can I get MDR such transactions? So yes, you can. There's something called multiple dwellings relief. And this is whereby you have 2 properties that you're looking to buy, and you can calculate the SDLT on the 2 transactions as individual transactions, or you can look at it as a combined price and find out what it is on there, or you can do averaging. So you can, there's different ways of doing multiple dwellings relief, but you need to pay a minimum of 1% of the total purchase price to do it. So yes, you can do that. I would always speak to your solicitor about the options you have on commercial properties, especially depending on what you're using those properties for, by the way. So do get some advice on that, but yes, you can get multiple dwellings relief on that. So let's just go through, because I'm missing out on the other questions that I'm meant to be going through, client questions. So I've not seen anything yet, that's fine. So how does Section 24 affect my tax bill when I buy studio flat for cash in my name or via an LLC? That's an interesting LLC. I've not seen it. The phrase LLC is limited liability company. Which, interestingly enough, is a term used by Americans for their company structures. We use the phrase LTD, so I'm not sure if I've actually got an American audience with me tonight. Well, that's fantastic if I do, but in this case, I think that maybe you talk about limited companies because they talk about Section 24 at the same time. So if you're buying things in cash, Section 24 doesn't affect you, so don't worry about it. What you do need to worry about is the fact that you have this whole issue of paying high rates of tax, and that could be 40% as a high rate taxpayer or 45% tax as an additional rate taxpayer. So you do need to watch out for that. You could put it into a limited company, and if you did that, then the amount of tax would be lowered to 19%. And from April 2020, the corporation tax rate is going to be 17%. Which is a fantastic reduction, which I'm very much looking forward to personally. So hopefully I've answered that one. So let's go through. Christopher said, what's the correct SIC code for a service accommodation business? To be honest, I wished I knew. I think, to be fair, There are so many SIC codes, but I'm just not privy to that information. I know about types, but SIC codes, you can go onto Companies House and obtain that information, Christopher, to be fair, but I can't, top of my head, I can't really remember. Christopher's asked a question. I'd like to make a loan from my contracting company to the new one for property investing. What are the tax and legal rules around this, and are there pitfalls I should be aware of? Great question. This is whereby you've got one limited company over here, which is cash rich because you're a consultancy business. And then you've got another limited company over here, which is dealing with property investments. And typically you're going to have one company who's got one SIC code for consulting and another company which got another SIC code for the property investing. And that's really important because mortgages will not want your consultancy business to have a mortgage on a property that you're investing into. So that's why you're using two separate limited companies. And you can take this cash rich company and make a loan. And I would say you typically would use a loan agreement and define the amount of interest they're going to charge it. Now, it's slightly different to what I said earlier, because I said do not charge from a company to an individual interest. But when you do company-to-company loans, I would suspect that it's pretty best practice to charge between 3 and 5% rates of interest, so that at least the consultancy business has got arm's length transactions going on here. It looks bona fide, and it pays this interest over to that company, and there's no CT61 as there would be for individuals. Now, so you can do that. You can have a loan agreement, and then this business can indeed buy property investments, and there's no issue. So hopefully that's answered that one. I'm going to be going to, I've got to get onto the client FAQs in a second, so hopefully we won't be skipping too much, but you guys are asking lots of good questions. So I really want to answer those as much as possible, but I'm going to come back in just a couple of moments, just so I can get back on schedule and talk about the FAQs from our clients. I'm just going to see what's on YouTube. Guys on YouTube are really quiet. Hey guys, I'm still here. If you've got questions and you're listening, please type in here. Equally, if you're finding this useful, then please just drop a comment below here as well, and then hopefully we can get going on this. So hopefully just let me know if it's useful for you, and at least I know you're alive as well. So that's sincere. Next one, let's just go through a couple of questions. I'll get them done. Perry's asked a question. I plan to buy a company through a limited company and hold long term for rental. I've heard I need two companies. Is this true? If so, do large property training costs go through investment company? Quite a few mixed questions there, Perry. I'm not quite sure where we're going, but let me, if I'm thinking what you're suggesting is that you've got one company that's going to acquire another limited company, which may or may not hold property investments. But there is an angle here, and I talked about this in another article that I've written, and it was all around stamp duty land tax in particular. If you buy a property residential, you know for one now you are having to pay 3% SDLCT surcharge, as well as the normal banded rates, which again, I will be talking about in my video on Thursday, so make sure you're tuned into that, and that's on a Thursday evening at 7 PM, that'll be launched. But the benefit of using a limited company is the fact that you are paying stamp duty rates, not stamp duty land tax rates. So if a limited company's got £1 million worth of properties, and I'm talking about net assets, you're paying on the net asset value 0.5%. So the stamp duty of buying shares is significantly less than buying residential properties, because don't forget, when you're buying properties, I talked about this 1 million net assets, but the purchase price of these assets could be 5 million. And if you think about 3% on 5 million alone, then it's a massive gulf in terms of how much you might be paying. So I always tell people to buy limited companies that hold properties portfolios rather than buying them out of the limited company. You have to do your due diligence though, because if you are indeed looking to buy a limited company, you need to make sure that there are no skeletons in the closets that could really come out to haunt you later on, in terms of debts or the bad deals that it's done in the past or legal issues that are coming up. So make sure you do your due diligence on those parts using good solicitors and forensic accountants. We're not forensic for this kind of thing for mergers and acquisitions, by the way, but there are some good accountants out there that can help you with that. Okay, so that's good question. So what I'm going to do, oh wow, there's another question, but I'm going to come back to this a little later on. And what I'm going to do now is just go to the frequently asked questions from our clients, and the big subject that is coming on, and it's a very much a contrast to what the papers are saying. The papers are saying, don't forget, we've covered off a few subjects now tonight, haven't we? But we talked about the papers that talk about selling those property investments and the whole issue of CGT, blah, blah, blah. But clients are professional landlords, property investors, call them what you will, but a lot of them are talking about this incorporation relief. Now, this is whereby you hold properties in your own personal name, and you know Section 24 is going to apply to you. You don't want that to happen. You can't pay down the mortgages, which would mitigate the impact of Section 24. So you are having to do something slightly differently. An incorporation can be done if you're using a simple strategy like partnerships. There is a Partnership Act 1890. If you're really boring like me, then you'll probably read dozens of pages on this kind of stuff, but you don't need to. Speak to a good solicitor, good accountant, and talk about Partnership Act 1890 and the criteria that came on there. And another interesting thing was the Ramsey case as well a few years back, where a couple was taken to court from HMRC to claim back capital gains tax because they moved their properties from their own name to the limited company. And HMRC said, well, you're doing a transfer to your company, which is a sale, and the sale of properties will incur capital gains tax. Well, the Ramsey case fought back, and it went to the upper tribunal. They won. The courts provided that they was managing the tenants, they were doing certain works on the property, they were doing their day-to-day activities. I think the word 20 hours came up. And as a result of that, the courts said, yes, this is a property business, not just a property investing, and therefore CGT allowances would be made, so no tax would be charged. And they got, I'm not going to say they got away with it, it now come case law, and unless they change legislation significantly, then HMRC can't stop you from incorporating your properties to a limited company. There are a few pitfalls to this. Partnership means two or more people. You do need to refinance your properties, and there is something called a latent gain, CGT latent gains, which people tend to ignore when they're looking to incorporate their properties. And latent gains normally means it is the difference between what the mortgage value is now versus the original purchase prices of your properties. And if your mortgages are now more than your property original purchase price, then you could have a capital gains tax liability, which is called latent gain. So you do need to think that through. You can do a partnership, as I say. You will need to have that as, for 3 years, and that means you can incorporate your property portfolio. So that's still such a big issue with our clients right now, and how to do that. We're working with Sam Horgan again and Cornerstone Tax in terms of partnership agreements, getting that in place, making sure the SDLT charges are correct, and we're working with them for CGT as well. The other big thing that's come out is service accommodation, or what I would prefer to call it, holiday lets. And the reason why I say holiday lets rather than service accommodation is that there are a lot of people that are selling fantastic property investing courses. But what they are doing, they're calling their products service accommodation, and service accommodation in HMRC's eyes is very particular in as much as you need to be providing services. Hence the reason why it's called service accommodation. What people are doing though is getting a property, converting it from a normal residential, putting it as a holiday let, putting on Airbnb, and maybe changing the sheets, maybe putting some breakfast in there. And that's pretty much it. And in the eyes of HMRC, that's more of a holiday let than it is serviced accommodation. And the reason why I'm kind of harking on this point is I had a conversation with Jake Liss, who is a capital allowances guru, if you like. So his company, again, is Six Forward for capital allowances. And he brought up to our attention that HMRC have said, well, to get to service accommodation and to allow capital allowances can mean that you can use those capital allowances, and if you've got losses in your property portfolio, you can offset the losses, therefore, against all forms of income in your self-assessment, which is great. But then what people are forgetting about is that they're using the phraseology service accommodation, but really it's holiday lets, and you can't do this sideways movements of using your property losses against other forms of income to get a tax refund from HMRC. So you do need to pay particular attention to what services you're generally providing. And I would say that the only service accommodation in reality is hotels, unless you're doing something significant with them. So changing sheets, giving them a bit of breakfast is not a service. Cleaning off before and after the tenant have moved in, well, not tenant, but the guests moved in, is not a service, because it's not the services when they're in situ. So you do need to be careful with that. And service accommodation or holiday lets do have VAT issues. By the way, the reason why we're doing all these holiday let service accommodation is because it's a mitigating section 24, so which is the mortgage interest relief cap. So you can offset all of the mortgage interest costs against your Airbnb or Booking.com products. You do need to bear in mind, which a number of clients are facing, is VAT. If you have a service accommodation, holiday lets, and you get into £85,000 worth of turnover, then you need to be VAT registered. There are ways around that by using flat rate schemes, but again, you do need to get tax advice about that. And lastly, people are talking about, obviously, using companies, whether that's for JV partners. And the one thing I would always say is make sure you get good legal advice. I see so many people setting up companies, going on to formations.co.uk for $12.99 and setting up a company. And formations.co.uk will give you ordinary shares, which is fine if you want to split the profits in the same way. If, however, you want to introduce different people into your business and you want them to have different rights as directors or shareholders in terms of receipt of dividends, then you need to use ABC shareholdings. Well, formations.co.uk don't do that. In fact, most of these formation companies don't really do it properly. And then what happens is that you have to unravel that. And because of that, you have to pay more money to unravel it in terms of the shareholding agreements and articles of association than if you did it properly first time. So please make sure that you use a good solicitor for that. And the other thing, before I move on to questions, because I appreciate now it's 22, so I'm sure there's questions that you're asking about these subjects, or indeed other subjects coming on, is children. You're maybe thinking about legacy planning. You might want to be getting your children involved in your business. Now, wow, guzzling this water down. I say it's water, it's gin. But if you have children and you want to give them money, you have to remember that if they are minors, and what I mean by minors is that they're dependent and they're under the age of 18 or 18 or under, any money that you give to them via yourself or via your limited company will be deemed to be your income. So even though you're thinking, well, they've got a personal allowance, why don't I use it? Well, if they're minors, in real terms, it will be classed as your income. So make sure that you do not start giving them earnings in that regard. You do need to be very, very careful of that. The other side of that is shareholding agreements. If you go for a mortgage in your limited company, which aren't always the best thing to do, the banks will require every shareholder above 1-2% to go through the mortgage application. But I don't know about you, but trying to ask a 13-year-old to fill in a mortgage application form is going to be a little bit tricky, especially when they're not very focused. So do be careful about that. But there are things that you can use in terms of growth shares and freezer shares to stop the issue of IHT. So IHT is a death tax. So as an individual, we've got a personal allowance of $325,000, and anything over above that will be taxed at 40%. but you can write into your shareholder agreements and your articles of association about gross shares, and any growth over and above a certain amount can be passed immediately to your children. You do need to get some tax planning advice on this. It's not something that we can just go, yes, there you go, that one trick works for everyone, because it does not, and therefore you need to make sure that you look at all the details before you proceed with that type of event. So that's pretty much covered off what's in the news and indeed what the clients have asked, and hopefully that's been useful. It's been good for me to kind of read this kind of stuff, so I'm really happy to do this weekly session. I'm just going to go into another question that's come about. I'm still not seeing many people on YouTube, so I feel really lonely here on YouTube. I've got to be honest, I'm going to have to do better than this. So the question from Jack Chan says, hi, there are so many questions, I can't get through them all, I don't think, but I'm going to give it a go. If I set up a limited company to do buy-to-lets and I fund the deposits with my direct loan, oh, right, I've already paid, I've talked about this. This is a bit before interest. So I've covered that, Jack Chan. So if you've been listening, hopefully you can go through that. It will be on YouTube as well. So do go through this session and talk about directors' loans, interest, and how it can pay you back, etc., in a previously answered question. So I'm not going to go into that in detail, but have a look at that. Perry's asked the question again. I plan to buy a property through a company for rentals. I've heard, in fact, I've done all of these questions and I'm trying to do them a second time, so apologies for that. I will just try and find the one that I need to. So MC's asked, I know I haven't asked this question, with a buy-to-let registered tenants in common in family protected trust, will there be a second property tax surcharge on all residential purchase for either of us? To be honest, it's probably, when it comes to trusts, I don't like answering those questions, if I'm honest. And mainly because it depends on the type of trust it is and how it's all structured. And people say, well, it's a trust, isn't it? It's the same. Unfortunately, it's not the same. And there are different types of tax issues that surround each different type of trust. So unfortunately, I'm going to have to leave that one there. What I would suggest you need to do is speak to your solicitor who's got tax practice behind them to give you some answers on this one. So it's a bit more complicated, unfortunately. I can't answer that tonight, or indeed at all, because I'm not sure the top trust. Rob's asked a question. Okay, I got another one, please. If a IT limited company transfers funds to an SPV and using Alphabet shares as dividends, is there any tax to pay at all? So if, interesting enough, if a limited company buys shares in another company and then that company pays dividends over, is there any form of tax? And the answer is no, because the company in question, the making profits in the first place, is already paid corporation tax. The fact that it's transferred money now to another company in form of dividends means that it's just an income, but it's already been subject to tax, so there's no further tax to pay. So that's a good one. I am told that this will be classified as franked investment income and will not attract tax. Is this right? I'm hoping I've just answered that. So that's good. So let me just get rid of these questions. And I think I'm up to date with my questions, which is great. Now I'm just going to view stream. I'm just going to press a button, and forgive me if this goes wrong. So I'm going to click on this and see if it works. Okay, it's gone live, so that's fine. Okay, that's all good. I just want to make sure that I wasn't screwing things up by pressing the wrong button here, but it looks all good to me. So let's have a look at the other thing. Okay, so there's no brilliant advice, Mick. Thank you, Michael. Michael, you're very, very welcome. Really pleased that's helped. I'm just going to see if there's any other points that I had actually from my point here. I don't think I've got anything to update you from FAQs in the news, but I am going to be here next Monday. So feel free to drop in your questions on our YouTube channel. I'm trying to build up my subscription base. So I am thinking about removing this webinar link as we've got it currently now. So I'm moving everything to YouTube Live. So that I'm bound to start that kind of structure. I don't know if it's going to screw things up, but please do come and join me on YouTube Live again next Monday, and just give me a bit of a high five and a thumbs up. By the way, do please go onto our YouTube channel, press subscribe, and press the bell for notifications as well, because I have got a video coming up on Thursday. You're going to want to watch that. It's also about SDLT, surcharge, and how to avoid it. So I give you some options about that as well. But until then, I'm going to say good night and enjoy the weather for this week. I'm hoping that we have great weather. I don't know why I'm looking at my watch. It doesn't tell me anything about the weather. So thank you ever so much. Let me just see if there's any last guest ones. So Rob's asked a question. Will recording of this webinar be available to view again later, please? Yes, the recording will be on the YouTube, on our YouTube channel. I've noticed, I keep saying YouTube channel. Please go onto our YouTube channel. Please press subscribe. Please press the notification bar. Please press like on this video if you really thought it was interesting. It just helps us build a community together. And I want to help as many property investors as possible on a weekly basis. I've got a new channel coming up eventually as well. But before I go, there was something else I wanted to kind of touch base with you. And that is, I've got a property in tax course coming up in Nottingham. So that's in Nottingham. It's Property Investors Tax Course, and that's on the 15th of June. So make sure you go to our Facebook page or Eventbrite and find us out on there, and tickets will be available for that. Equally, if you want tickets and you can't find the information, simply go to our YouTube channel. Again, it does have all the details on there as well, and it gives you a video outline of what the course is all about. Guys, thank you ever so much for joining me tonight. Please come onto YouTube. I'm trying to build that up as much as possible. So it'd be great to come in and see you more regularly on YouTube. And until then, have a fantastic week, guys. And I look forward to seeing you next week. Thank you. I can't get off. So the next thing is how to end these meetings. And this should be kind of the bloopers right now, because I'm looking at my technology thinking, okay, this camera's staring at me and I'm staring at this and I don't know how to finish this one. But I will get there. Thank you ever so much for attending. And again, I shall see you next week, and I will conclude it this time around. Thank you, guys.